Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm here today with Todd Miller and Steve Farrar of my team, also formerly of NCUA. Guys, how are you doing today?
Good morning. Windy and cold here in Montana today.
Windy and cold, a good day to talk about camels.
Absolutely.
We even had some road closures around here.
Road closure.
Weather.
It's going to be 90 degrees where I'm at. I wish I was windy and road closures. 90 is a little too hot for me. But speaking of hot, we're going to talk about camels. But guys, can you guys, in case someone's listening for the first time or watching for the first time, can you give a short summary of your background before we jump into what's going on in the world of camels?
I'll go first. 30 plus years at NCUA. NCUA career is broken into two parts. The first half would have been in the field as primarily a problem case officer, predominantly on the West Coast, but involved with a lot of turnaround situations, conservatorships, enforcement actions and that sort. And then I followed you to the central office, and I worked remotely from there for many years in the Division of Risk Management. And in that, I got to be involved in a lot of things. The best thing was I did a week of training for the problem case officers. Actually, everybody had to take it on. Problem resolution, work on the enforcement, instruction, and just a lot of issues. When 2008, the corporate situation helped with that. Then I worked towards the end. I worked a lot on the risk-based capital rule, and then we've been at this consulting now for, is it what we say, 6th year?
Yeah, we're in the 6th year. Isn't that wild? Wild and crazy.
So along those lanes, it's been really nice because we can kind of apply what all we learned, and then we also, it allows us to keep up with what's going on out there.
Yeah, well said. Todd?
I spent 34 years with NCUA. I can kind of break my career into three parts. First part, like Steve, I was spent as an examiner, problem case officer. Then I spent a decade as a capital market specialist in the West Coast, did a lot of training and developed a lot of NCUA's training on interest rate risk management and liquidity. Spent a lot of time in complex credit, both good and bad. The last decade of my career, I spent it as the director of special actions in the Western region, supervising problem case officers, capital market specialists, regional lending specialists, or the director of special actions. Of course, you're dealing with the most complex credit, even the biggest problem cases in the region. I did do a number of conservatorships. I never kept count of how many I did, but I did keep count of the 2 I returned to the members, because those were kind of highlights in the career, and you're always satisfied. And you can take a troubled institution, put it in conservatorship, and give it back to the members. There was a last year there where I was reassigned to market and the conservatorship of West Court. I call it a lot here because I wasn't allowed to talk to anyone. I did stay with NCUA about a year longer than Mark and Steve, so Mark called me in when I retired. I've only been at it 5 years because I stayed with the agency a year longer than these other 2 guys.
That's right.
Very satisfying career in NCUA. And it's been very satisfying the last 5 years working with Mark and helping credit unions out.
Yeah, this is a lot of fun. I've learned a lot since leaving NCUA about how I learned a lot while I was there, but I've learned even more, I think, since. So guys, camels, a lot of time and energy and angst goes into what's the camel rating going to be. And I'll probably use camel and camels intermittently because camel just sounds better. But of course, we have the S that we've thrown on the end there. But under the leadership of the Trump administration, we have a lot of deregulation going on, and that's bled into camels. And they've rewritten the rule for the first time in 30 years. I've got a PowerPoint here that we may go through in detail, but it's really kind of our agenda. But it's been 30 years since the last comprehensive change in 1996. It's approved by the FFIEC. All the banking regulators have to use it, so they run in unison, which is why NCUA is part of this. We may point out some of the reasons that it's a little different for NCUA. But anything on this slide you guys want to hit, or any opening comments you want to make before we jump in?
Yeah, Mark, do you recall what the system that we had at NCUA when we first started was called?
Early warning system.
EWS.
EWS.
And how did we decide what the EWS code would be?
Based on management.
Yeah, probably. Well, also up around here because of our distance and travel, my trainer had taught me, don't code anything more than 100 miles from your house, code 3 or above.
Yeah. Well, and so they got rid of, that's a really good talking point too. They got rid of the early warning system because it put too much judgment into it for the examiner, and you could get ticked off about one thing. So they led to the CAMELS score, where it was originally, I think, based on, we had a matrix, and if your earnings was X, you'd start off as a 2, and if it was Y, you'd start off as a 3. But then it would all kind of come home to roost in the M rating, which still had a lot of judgment. And a little bit of what's happening here is some ability to use judgment is going out the door. Todd, any thoughts for you as we jump in here?
Now, as you mentioned, the EWF, I just think of the multi-part carbons and the fact that you only had about a half inch to explain each thing.
Yeah, that's right. And if you started using your typewriter and you got into the middle of a sentence, by God, you'd figure out how to get out of it so that mostly made sense. And the goldenrod in pink. I didn't know what goldenrod was till I had those carbon papers.
We might be dating ourselves here, though.
We might.
Yeah, we're on carbon, 3-part carbon.
Yeah, that's right. We are dating ourselves, but that doesn't mean we don't know what we're talking about.
Yeah, we had to do our own math.
Well, right. That's a great point, right? Because then when they turned it into spreadsheets, we knew where the numbers flowed from, and they had to actually train that into examiners a little bit more than us, because we had to do the math. Like you said, we had to figure out what the solvency ratio was versus the net worth ratio. God, that would bring back lots of good memory, good and bad memories. All right. So this slide, we just, of course, we've got capital adequacy, asset quality, management, earnings, liquidity, sensitivity. You get a 1, 2, 3, 4, or 5 in those categories. I'm going to blow by this one here. So here we're getting into some of the meat of what's being proposed. So there's a proposal out there that talks about making changes to CAMELS, and these are some of the highlights. Guys, let's kind of walk through these or anything else you might want to say relative to what's on the slide. Anybody want to start?
It's a chicken or egg question in my mind. So you walk into a crane as an examiner, you start with the composite and then figure out your components, or do you figure out your components and decide in composite rating? I will just say over my career, I did it both ways.
Steve?
Yeah, I mean, I was a real numbers-driven person more than anything, but my difference was I was more interested in what do the numbers look like 6 months from now. That had a lot to do with how we'd ultimately decide on that, the composite score.
This reminds me of a thing I say on occasion, which is it's more like it's more like jazz music than classical music, or vice versa. But by getting rid of judgment, it becomes more like classical music that you need to play in a particular way. Jazz music is a little bit more impromptu and free flowing, and the changes to the CAMELS is going to take away some judgment, and judgment I kind of relate to that jazz comparison. Any thoughts on the first bullet here? Management no longer gets primacy in the composite. The agency's own data shows that was the most influential factor. Any thoughts on management there you want to mention?
Me, I don't know that one.
Okay, next up, trim management factors. Removes depth and succession, responsiveness to auditors and supervisors. We had a client recently that got dinged for not being responsive in a way that didn't make a whole lot of sense from our perspective, but and willingness to serve community needs. Thoughts on that? What can go into management?
Well, I think on that one there, really, FDIC is reviewing what they call process-related issues. And then that's kind of where that one comes into play, is like these items are more along those lines.
Trying to give an example of that whole process. So we had out there a group of credit unions. I'd call them perpetual threes. A lot of them were smaller credit unions. they would have these unresolved findings. Sometimes they would sit there for literally a decade. And the code 3, the same unresolved findings. You have these process issues that were given in the CAMEL 3s, but their financial performance would be consistent. It wouldn't be great, but it would be consistent. Capital would stay level. We weren't going to give them a code 4. We weren't going to give them a C and D. We weren't going to code them a 4 when they're, 300 miles away from home, because they just floated along. Eventually management was going to retire and, they would probably merge. But a lot of those, they were process-related code 3s. Really, the credit was fairly resilient. And that's one of the, maybe getting ahead of ourselves, but the things that disappeared in all the ratings. So if you look before, there was a lot of mention about resiliency to financial change. All that language is gone in this one. It's a little bit with the 3 and 4 composite, but an NCUA CAMEL system, they mentioned resiliency in just about every single component. And that language about resiliency to financial changes, that's all gone. That kind of jumped out at me. We throw in the material risk threshold. We take out all this language about resilience.
Well, and in that regard, so resiliency, when I hear that disappearing, and I think what Steve talked about, what's it going to be like 6 months down the road, and, basing it on the numbers, but you want to also be forward looking. Resiliency seems to be a forward looking concept, right? And it makes it harder to look to the future. It sounds like it almost has to be more based on just the math.
It almost sounds like when you read their definition, you want to code them based on your exam date, not where they're going. Like Steve had said.
Yes.
We want to give them a grade where they're at today. And there's good and bad to that.
Yep. Good point. Any other on this slide? Anything else jump out, guys?
Yeah. Number 3 is a big one. This is that material financial risk, right? Are we covering it later, or
let's do it now. We can piggyback off it later.
All right. Because it in the notice and request for comment, it is in there 38 times. So it tells you that is a major issue. And so I was like, make sure that we really understand what they believe is a material financial risk. And the definition that I could find, material financial risk, is any act, practice, or failure to act by a financial institution that has already caused material harm to its financial condition, or if continued, could reasonably be expected to do so. This includes risks that threaten the stability of an institution's earnings, capital, or present a material risk of loss to the insurance funds. So that is the basic definition of material financial risk, which is it's defined.
It's defined. It's not like defining beauty exactly, because it is defined, but then anytime anything is defined with words, what do those individual words mean within that definition? And,
yes.
and then how does this relate to safety and soundness, or unsafe and unsound, which I think we'll get to as well. Todd, any thoughts on this number 3 here?
Yeah. When do the immaterial things become material? It's that forward-looking thing. You look at new programs, for instance. Let's just take Centrix from many years ago, because no credit unions are involved yet.
Good example.
It started out very small in a lot of credit unions. Examiners did identify a lot of process-related holes. And eventually, it became quite large, and it caused several credit union failures. But went along to that matrix, this new program that started out small, become the material financial risk, became the processes, and eventually things crumble. It's just kind of an interesting question. It went along. When does that concentration risk hit a point where this becomes the material thing?
Wow, that's an interesting take. Yeah. So an NCUA is big on concentration risk. They have letters to credit. I believe the letters are still out there. Maybe they'll pull some of them under the letters more.
The concentration risk is mentioned a couple times in the revision.
Okay, good.
But still, it's back to Steve's thing, he was looking where things were going. This proposal seems to, I want to grade you on this day. Yeah. Is it going to result? And, part of it is going to be how well are examiners trained on this? How does it change their behavior? But there's still a piece of it. Do examiners catch things and address them early enough before they become that material financial risk? This is almost, let's wait till it's a problem before we deal with it thing. Or there could be a propensity for that to occur the way this is.
Sure. And when you say that, I think, well, short term, if I'm a credit union or if I'm talking to one of my clients, a more restrictive CAMEL code downgrade is viewed as a good thing, because if you don't downgrade me as quickly, or you don't do a warning shot code 3, or I just want to make a point code 3, you're eliminating those options. That's a good thing for a credit union. Long term, if you're focusing on the past instead of what's on the road in front of you, the likelihood of that leading to some insurance fund losses is real. And I'm going to be recording a podcast, updating a podcast I did on the conservatorship that happened at NCUA recently, where there's about a $70 to $90 million loss that's brewing to the insurance fund. And so when those things start dropping out of the sky and credit unions might have to pay money into the insurance fund, and there might be a change, in the White House that has a reaction to change all this CAMELS back, it won't be as fun for credit unions at that juncture. But that's kind of one way to look at it. Any 4, 5, or 6 on here? Anything here you want to highlight, guys?
Well, it says the composite recalibration. If you read the definitions, they didn't change very much. Like I said, they took out the resiliency type of thing. But I think for the vast majority of credit unions, this isn't going to change their CAMEL composite at all. And the definitions are very similar to what they were before. You mentioned the big changes in that material risk threshold. They took out a lot of process-related stuff. It's the credit union just kind of right at the edge between, a 2 and a 3 or a 3 and a 4, where this may have some impact on how they get rated. And the big question will always be, how does NCUA institutionalize a new rating system with examiners that have been using the same one for 30 years?
Sure. Well, a lot of those 30-year-old folks that have been doing it, not 30-year-old, people have been doing it for 30 years, left in the buyout. And of course, they've got 27 to 30% less staff. So how will they train? How will they socialize this is going to be a very big part of what actually does or doesn't happen here. But you're right. A lot of credit unions that have been code 1s and code 2s forever aren't even really going to notice anything. It's when you get to the edge of a 3 or the edge of a 4 where it's going to get more challenging. So what is it? We got the big one, demoting the M. Management loses the special consideration that let it override the other 5. Thoughts on this concept, guys?
Yeah, most of them captured in the slide, but there's another little piece that kind of affects a lot of our clients, because we see this in findings all the time. NCUA's current rating system, when they have it in literally every composite rating, they have it in all the components. They talk about it in the management rating. They take out the word risk management systems commensurate with size and complexity. That's only in this proposal like once or twice, where before it was everywhere.
Okay.
Examiners use that a lot in their findings. When you read exam reports, when they describe their composite rating, especially when it was down there in a 3 and a 4, they would use that language all the time to justify their rating. Your risk management systems are not sufficient for the size and complexity of the credit union. They took that size and complexity out of their rating system just about everywhere. So it kind of speaks to maybe there's more objective criteria involved here rather than this size and complexity, which means different things to different examiners.
Yeah, that's a great point. Size and complexity is a judgment matter, and they're trying to eliminate the judgment. Steve, any thoughts on that or anything else on this slide?
No, that was a good point that Todd made there.
And then I'll just highlight for those of you who are listening and not watching, under the proposal, management is weighed alongside the other five, not above them. The composite is meant to reflect overall financial condition. No single leg should quietly drive the score. So that could be where, if you got a 3 in capital and you had 2s in other things, but the capital was something that the examiner wanted to make a big point on, they might give management a 2 or a 3. The ability to weigh heavily on one thing in management is being watered down, for lack of a better word. So let's see. Here we got the new bar for a downgrade. To land on a 3 or worse on management, there now has to be a material financial risk, not just a process gap. Thoughts on this?
I think it's kind of a good thing, we see this all the time with exam reports. They'll get downgrades, not because management is doing something wrong, but because there's no documentation of their decision-making process, or they'll get downgrade because of policy issues. We've seen this with liquidity, especially where their liquidity position is fine, management has strengthened, but their policy allows a risk threshold that's quite low, so 2 or 3, and they'll hang a 3 on that component just because their policy allows it, not because management does it. I thought it was always interesting when I was in credit, especially with loans. I would go look at a half dozen or 20 loans, and then I'd go read the policy. But what do the loans really look like? Because sometimes good policies don't necessarily need good practices, and weak policies don't always indicate that you have bad practices either. Sometimes experience weighs a lot, or management can be really effective, even all that documentation isn't there. And this is going to kind of give those folks a leg up, if you would.
Yeah, that I always used to use the example of that I'd rather have a good quality commercial loan portfolio and a policy that needs some tweaks, as opposed to a great policy, but the quality wasn't as good, right? So it's a great point. Steve, any thoughts here on this slide or what we've been chatting about here?
Yeah, I mean, one of the main goal is in the notice is the improving consistency. So I think in what a 3 in management looks like and what a 3 composite looks like would be a little bit more comparable credit union to credit union than it can be now.
Yeah, great point. Great point. And on the slide, I'm going to pull out an item here I had highlighted in yellow. The carve out to watch. Examiners can still assign a 3+, so 3 or worse for unreliable reporting, failure to safeguard assets, or significant non-compliance with law or regulation. So compliance still has a lot of teeth. I can see as they're de-emphasizing, just thinking how this plays out once it's up and running 1, 2, or 3 years. So you have less judgment that you could instill. And Todd, you kind of said, do you walk in and come up with the kind of the code and then kind of work backwards? Or do you come up with the individual components and then you come up with the final? And sometimes you've used either. What I could see is if your gut is telling, because you have your gut instinct, right? When you do what we did for 34 years, you're there a week and you know, just because of everything you know in your head, that this is a 3 or this is a 2, and then you kind of work backwards to that. What I see kind of happening here is if that's where your brain is going and you can't use it with judgment, they're going to highlight failure to safeguard assets. They're going to highlight significant non-compliance with law or regulation. So where NCUA may put the hammer down is that law or regulation when they really want to support a 3. If you violated it in a less than a material way or a material way, if they want to support that 3, they might use that hammer a little bit more than normal.
You can drive a semi through unreliable reporting.
Good point. Well, unreliable reporting to who, right? To NCUA, to the board? Not documenting enough corporate governance, would that fall into unreliable reporting? I don't know.
I can shoehorn it in there.
Right? Yeah. So that's the thing is when you change even like Steve earlier we talked about, it's good we have a definition. but that definition is made up of words. And then the reality is they have what now, 4,500 credit unions that get exams done every 18 months. As you get out there, these fixes that make it less judgmental will get watered down over time as they figure out how to use their judgment based on these new words.
The saving grace for credit unions, like the unreliable reporting, like I said, you can put anything under that, your credit risk management systems, your liquidity capital forecasting, your budget reports and everything. But at the end of the day, when they write citations, they still have to come back to a regulation, not the CAMEL letter, unless they turn this into a regulation, which I don't think they're going to do. So there is that little bit of protection still on somebody when they still have to cite regulation.
Great point. Great point. And so the slide I pulled up here talks about, is this good or bad? What are the pros? What are the cons? The supporters out there, those who crafted it, those who are talking about it from overzealous examiners, that the M became a catch-all, that exams got bogged down in dotting I's and crossing T's on documentation instead of appropriate things, and that it's clearer, more measurable factors mean more predictable outcomes. The other side of it is tying concerns to financial weakness can miss problems before they surface. Management is the early warning system. Weak oversights creates tomorrow's losses, and it could water down examiner discretion to flag emerging risks. Any of those you want to flush out?
Well, I'll just say one thing, they removed the whole management succession plan and things. In the Western region, examiners got reports when there were changes to CEOs, because there's kind of the big time supervision you need to pay attention when places get new management and they take new directions. And 90% of the time, that new direction is really good. And then there's that other percentage of time where that new management team takes a left turn and goes off the road, so to speak.
Well, and along those lines, right, to get the last time they changed the exam cycle, they previously didn't allow $1 billion plus credit unions to have the extended exam cycle. When they put them into the pool of eligibles, I think one of the things they have on their qualifications is you've had to have the same examiner, or excuse me, the same CEO for the last 2 cycles. So if there's a new CEO, they're going to come in quicker, which is a good thing.
And then your point down there in blue where it talks about the failures, mainly Signature Bank is the one that's most often pointed to. There's also Silicon Valley Bank that was a big failure. And they find from FDIC documents, failure of Silicon Valley illustrated the issue where most of the outstanding supervisory criticisms when the bank failed were unrelated to core financial risk. One criticism related to interest rate risk was focused on the bank's modeling rather than a hole in the balance sheet. So you got to figure examiners might have been even living in that institution.
Yeah. Yeah.
Well, when we had people living in Westcorp.
Yeah. No, absolutely.
Yeah, and sometimes you just gotta shake your head at like some of the things that how that ended up getting what happened there.
Great point. Great point. And Signature and Silicon Valley Bank were huge losses to the FDIC fund that got charged back to credit union, or excuse me, got charged back to banks. And anytime you make it harder for an examiner, you can argue that it's a good thing, and it might be a good thing. But if you take away some of their tools, eventually there will be some losses. And of course, NCUA is kind of an insurance company and insurance fund, right? So there should be some losses. And you shouldn't have unlimited resources, but you should have the right resources. So here we are in a period where they've cut 30% of their staff and they're watering things down. No doubt in my mind that in the short term, that's good for credit unions individually on exams, but in the long term, it's going to lead to some losses. And then when there's losses over certain dollar amounts, the inspector general has to do a loss report and then comes up with recommendations. What do you think those recommendations will be when that happens? Maybe you should go back to a harsher CAMEL. Maybe you should hire more staff. Maybe you shouldn't do this, should do that, et cetera, et cetera. So life is a pendulum in Washington, D.C., and we've seen it go both ways. Any thoughts on what I just threw out there?
Maybe a topic for a podcast, and we're not all very honest about what really went on with our postmortem.
Not really that honest. Could you repeat on the
We're
postmortem?
not really honest about what really happened in the crediting with our postmortem. They all kind of point to examiner or to management mistakes. On the crediting side, they're rarely willing to admit NCUA's mistakes. They will have recommendations for it. Because as a director of special action problem case officer, you get to read postmortem. So you've actually been there, and well, that's not exactly what really.
Yeah, that's a really good example because they came and interviewed me for the postmortem of Westport, and I kept telling, the thing you can't forget is it was the mezzanine structure of the investment that they held, which is why they fell the way they did. The word mezzanine never occurred in the postmortem. I mean, as soon as I got it, I was like, we did a word search for it, and I'm like, I can't believe it. The whole issue as to why those investments were bad didn't really have to do the fact that we had those poor mortgages behind it. It had to do with the structure.
Right,
Missed.
right.
And that was missed by our examiners and the postmortem, everything. So it can be as simple as something, the failure can be caused by something as simple as that. And then if you concentrate in it, you put the insurance fund at risk.
Yeah, well said. Great point. I hadn't heard that word mezzanine. Usually, it's when I'm on Ticketmaster, looking for the nosebleed seats. But yeah, the mezzanine is where the higher risk was. And even though it was AAA rated, the mezzanines were blowing up, and they had a lot of them. So other items that kind of relate to this, and Steve, yesterday when we had a little bit of pre-conversation and a pre-meeting on the recording of this. All right, guys. So Steve, you had mentioned unsafe and unsound, and that there's an advantage to banks in some instances because there's a definition of unsafe and unsound, and NCUA doesn't really have one, and that kind of weaves in here. And then another thing that recently got watered down on CAMELS was the removal of reputation risk from consideration in CAMELS. Any thoughts on either of these topics, guys?
The unsafe and unsound one is an issue that I always have had a lot of interest in because when I was training examiners, I'd always ask them, where in the regulation is unsafe and unsound defined in there? Because we talk about it all the time. So where is it? And you'd see them, looking through the material. Where is it? It didn't exist. It was all based on kind of case law practices on it. Then, in October, as you have on here, the FDIC did issue it's not a rule, but it's one that's out for comment, I think, to establish uniform definition for the term unsafe and unsound. And they define the term unsafe and unsound practices for their purpose of 12 U.S.C. 1818 as a practice, act, or failure to act alone or together with other practices, acts, or failures to act that is contrary to generally accepted standards of prudent operation and has materially harmed the financial condition of the institution, or if continued is likely to materially harm the financial condition of the institution, or present a material risk of loss to the insurance fund.
Interesting.
Yeah,
Todd.
and then along those lines, they've also kind of are directing that their documents of resolutions would be more specifically addressing just kind of those major, like we call it, this significant financial risk. They're trying to have those doors much more specific to material financial risks. And I think we see the same thing as Todd and I can tell you when we would take over cases as problem case officers and we'd look at the document or resolutions, and we'd just like, They didn't make them get meteorite insurance. It would have so much stuff in there and not focus them on the most important issue that was the material financial risk. So when we took over cases, a lot of times they go from a door that contained 15 items that we might have 5 and be like, we got to fix these 5 things. And then, then we'll work on the other, we will work on the others, but they're not as important. So that was, I think, what hopefully might come out of this.
That's, I like that. Yeah. And if everything's a priority, nothing's a priority. And that's one of the things credit unions would get assigned to special actions and thinks it was going to get worse. And oftentimes it got better because the staff was the most experienced and the staff had seen more. It's kind of like the three of us. Sometimes I'll describe to clients is we saw everything that happened at NCUA. We were involved in the most crazy things. So when we see things that are less than crazy, we don't overreact. And that can be an overreaction where you have 15 doors or 15 findings when you really only need to focus on these 3. So maybe that'll be the silver lining is that they'll use a little bit more discretion on what actually gets into these reports. Todd's, any thoughts on unsafe or unsound or reputation risk to add here?
Reputation risk came up very rarely. Occasionally in a small town, you did a stupid program or something. In my career, it was very rare for it to have immediate impact on a credit. Yes, you could get a bad reputation as an institution and it could affect your growth for a decade. I mean, you would hear bad things sometimes about credit as long as a decade out when they did foolish things that were known to the public. But in the big scheme of things, it didn't play into CAMEL rating or risk rating very often.
Yeah, great point. Great point.
So it was just a rare thing. And then in this NCUA getting rid of its experienced staff, this plays into it. You mentioned the problem case officers and folks like Steve and I focusing on just the 3 or 4 more important things. That's an experience. The younger examiners, less experienced people, less experienced supervisors. I mean, there is the quality control thing, so supervisors should be controlling it too. But less experienced people, they tend to err on the side of let's get everything in there, kind of the CYA type of move. And, it takes time and experience to be comfortable to say, let's set these other things aside and fix these 2 or 3 things first. And NCUA's lost a lot of experience, and it would be interesting to see how that plays out. But I mean, we've seen it with some of our clients for 17, 18, 30 things that they're supposed to deal with. It's not going to be able to deal with all of these.
And if they do these
hours in the day.
And if I do these 3, it's not mathematically impossible to do these 4, right? Yeah. Incongruent reporting. So this is we're getting closer to a wrap here. What it means for your credit union, succession and soft findings. We've got share insurance fund framing, newer to full CAMELS. CU's only adopted the 6th component. Yeah, that's not that big a deal here. Compliance still bites. Any thoughts here on this slide? Any of those 4 topics, guys?
I think we've touched on a lot of it, but Todd and I can never overemphasize the reliable reporting issue because it was just a thing that you just could never get past, and it still comes up more often than you would expect. And that was always the biggest headache. And then their immediate fear is if I don't know what's going on, I'm uncomfortable.
Yeah. Because unreliable reporting can lead to losses, can lead to fraud, et cetera, et cetera. Great point. I think this goes into the whole safe. This slide goes into the unsafe or unsound. I think eventually NCUA is going to have to come up with they'll approve this change, and then there will be this gap on safe and sound, and hopefully NCUA will. And their new chair, if and when he gets in, will define that. Any thoughts on this slide, guys?
Well, essentially, the FDIC's definition of unsafe and unsound in terms of if it's really defined by case will become basically the standard that would
Great point.
apply
Yeah,
to the industry.
It'll bleed to credit unions. Great point. And again, if you have thoughts on what we said here, reach out to us. If you have thoughts on what should or shouldn't be in the proposal, you have until August 17th to reply and provide your comments to NCUA or the FFIEC or wherever those comments should go. It's outlined in the proposal, no doubt.
Yeah, then they did have specific, what is it? It's 11 specific requests for comments on questions that they have proposed. And that's what you do when you're sending out the first part, when you're sending out a notice and request for comment. That is essentially kind of the fishing expedition in the rulemaking. And then you do a proposed rule and then final kind of rule. So I imagine it would follow the same process.
That's right. I don't think you mentioned it this time, but you were the architect of the risk-based capital rule. And like you said several times, once they figure out you know how to write a rule, they have you write several others. So you understand how that mechanics of that all works.
Mm-hmm.
All right. Good night.
Well, yeah, there's already, you can go on and you can see there's already a number of, I think it was 20 yesterday.
Really?
I didn't read them, but if you really want to find out what people are really saying about this, you can always look at what comments they're getting in.
And were those on the NCUA website? Is that where they're?
No, it links through with, if you just
Okay.
pull up just any Google search off of, I think I ended up in it. It's off of the Federal Register site where it has where the comments could get posted.
Very good. Very good. All right, guys. So Todd, I'm gonna go to you. Any final thoughts on CAMELS?
We only talked about the management component rating, but the capital markets specialist in me just has to go look at how they change the sensitivity rating language in this. We've always done podcasts for the whole exam solutions where we talk about, hey, earnings should be weighed much more than this whole NEV. And you go look at all the component things in the sensitivity, heavy emphasis on earning, a little bit on market risk. Let's just say NCUA supervisory test as a risk rating measure is not congruent with what this letter says.
Really? Really?
As factors to evaluate sensitivity.
That's fascinating. Well, maybe that will disappear in the longer term. I know that the current executive director, Larry Fazio, was a big push behind that NEV model back when it was put in place to solve some real issues. And of course, we've talked here about how not as good as income simulation, and it can create some issues, and it's a little bit of rough justice. But maybe the NEV test is something that'll fall away as a positive because the CAMELS is incongruent with it. I like that take.
Yeah, and I think just this whole notice and request for comment, it essentially would be a good training tool for board members if they've been around for a while and to read, because as with some of the other stuff that's been put out, it's got a lot of really good basic information that will enhance the ability of board members to certainly understand what they should be doing and looking forward. So I would say it'd be a good learning tool for board members and staff, senior management staff.
Great point. I'll put a link to it in the show notes.
I thought they did well in writing it. It follows the plain writing. They shortened things up down to just the meat. They took out all the little flowery language that regulators like to use, like the size and complexity and all with the resiliency stuff. It makes it an easier read than what we had before. And, they laid out, here's the factors we're going to use to evaluate each component. And it says examiners throw in something else. You really got to justify those other things. And like I said, in the big scheme of things, I don't think people's ratings are going to change very much, just though that the edge that we talked about during the podcast, you're just right on the border. You may end up with a different rating or this if it comes to fruition.
Excellent. Yep. Great point. Great point. All right, guys, this has been a lot of fun as always. Thank you for your time and your service. And listeners, watchers, I want to thank you for listening or watching. I hope you will do the same again soon. This is Mark Treichel signing off with flying colors.